From palm oil giant to a $20 billion global powerhouse, Wilmar International just made their biggest move yet. They're spending $1.4 billion to dominate India's food market. But is this golden opportunity worth your investment dollars? Let's break it down together. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers with over 800,000 reads. I've produced over 600 videos with more than 280,000 watch hours as of November 2024. I also focus on regional and world economy topics. Today, we're diving deep into a story that starts in the humble plantations of West Sumatra and grows into a global success story. Imagine starting with just one plantation and growing into a company with 500 manufacturing plants across 20 countries. That's Wilmar International's journey, and they're not done growing yet. Think of Wilmar as Singapore's very own food empire, like your neighborhood kopitiam, but on a massive scale. They make everything from cooking oil to sugar, flour to rice, and now they're making their biggest move ever in India. It's like buying over the biggest food court chain in a country with 200 times Singapore's population. Let's talk about this mega deal that everyone's buzzing about. Wilmar is spending $1.4 billion to increase their stake in Adani Wilmar Limited to 75%. To put that in perspective, that's like spending the cost of about 1,000 HDB flats just to get a bigger piece of India's food market. Why such a big bet? Because India isn't just any market. It's like having access to 1.4 billion hungry customers in one of the world's fastest growing economies. Have you ever wondered how companies decide when to go big or go home? Stay with me as we unpack whether this massive bet will pay off. Now let's look at Wilmar's financial health. Think of it as giving the company a medical checkup. Their market value stands at SGD 19.35 billion. Which is like having 19 Marina Bay Sands. They're offering a dividend yield of 5.48%. That's better than most fixed deposits in Singapore. For comparison, DBS's fixed deposit rates are hovering around 3.5% in 2025. But here's where things get interesting. Their recent earnings report shows a 35.7% drop in profits for Q3 FY 2024. That's like your salary getting cut by 1/3. Should this worry us? Well, it depends on whether this is just a temporary setback or a sign of bigger problems. Ever noticed how sometimes you need to spend money to make money? That's exactly what Wilmar is doing, but is it too much, too fast? Let's break down the good stuff first. Wilmar isn't new to India. They've been there through their partnership with Adani for years. Their Fortune brand is like the Tiger Balm of cooking oils in India. Everyone knows it. Plus, they can use their global connections to get better deals on raw materials. Kind of like how bulk buying at Costco saves you money, but every investment has its risks, and Wilmar's got some challenges to tackle. Their debt-to-equity ratio is 1.22. Imagine having $122,000 in debt when you only have $100,000 in assets. That's not necessarily bad, but it's like carrying a heavy backpack while trying to run a marathon. Want to know what the experts think? 5 top analysts are giving this a moderate buy rating with a target price of SGD 3.47. That's like saying there's potential for a 14.43% gain. The integration of such a massive acquisition isn't simple either. Think of it like trying to merge 2 different families with their own ways of doing things. It takes time, patience, and careful management to make it work smoothly. Looking at the bigger picture, Wilmar is betting on India's growing middle class. As more Indians earn more money, they'll want better quality food products. It's like how Singapore's food preferences changed as our country developed, from simple hawker fare to premium dining options. The company's also working on sustainability initiatives, which is crucial in today's market. They're investing in renewable energy and sustainable farming practices. Think solar panels on factory roofs and using agricultural waste to generate power. Engagement. Hook. Did you know that sustainable companies often perform better in the long run? Let me show you why this matters for your investment. For investors considering Wilmar, here's what you need to know. The company trades at a PE ratio of 8.8x, below market average. That's like finding your favorite chicken rice at a discount. They're projecting modest earnings growth of 5.1% annually over the next 3 years. Not explosive growth, but steady, like a tortoise rather than a hare. So who should invest in Wilmar? This stock might be right for you if you're patient and looking for steady dividend income. Think of it as planting a fruit tree. It takes time to grow, but once it's mature, it can provide fruit for years to come. Before we wrap up, let's address the elephant in the room: timing. With market uncertainties in 2025, including global interest rates and commodity price fluctuations, you might want to consider dollar cost averaging rather than going all in at once. Elephant in the room. If you found this analysis helpful, check out my previous video, Wilmar International Buy, Sell, or Hold, where I dive deeper into the company's financials and growth strategy over the past decade. Don't forget to hit that like button and subscribe for more Asian market insights.